Well, the recent decision by the Kenyan Central Bank for the 100 basis point cut to 8.5% on the interest rate there has had ripple effects to the shilling and the current account deficit. Of course, that has been one of the concerns cited by the central bank on that end, the concerns around the current account deficit, 11.4%. But let's get a view from Grace Makoko, Head of Financial Markets at East Africa for Standard Chartered. And we've also got Roy Daniels, Head of Africa Trading at RMB, joining me here in the studio. Grace, I'll start off with you. Let's just start off with the 100 basis point cut. Do you think that this was the right move for the economy when it comes to the need to stimulate credit extension and help businesses borrow a little bit more to help fuel economic activity?
Absolutely. I think for a long time, given the high inflation that we came out of, we saw credit growth slow, and generally the private sector, lending to the private sector drop drastically. So I think top on the mind of the MPC and the central bank, what they want to see is growth stimulated. How do you do that? You get the private sector borrowing, you get banks to lend. Currently, lending rates are still high. So I think this is a signal to the market that, that's top priority and we need to get on with it. We need to pass on credit to the private sector. I think secondly, also, one of the hallmarks of the CBK and the MPC in the last 12, 18 months has been predictability, which is what markets are looking for, what investors are looking for. We all want predictability, and I think we've been able to fairly accurately predict MPC's actions, and they have been coherent, they've been consistent. You can see where they're going, and we absolutely, as a market, welcome this.
It almost is a big improvement from where we saw monetary policy in Kenya 2 years ago, when we had inflation almost out of control. We had the shilling on a downward trend, and it seems like everything's a lot better when it comes to direction, clarity, and certainty. Roy, from your perspective, is that how you're reading it right now?
Certainly the case. I think we went through a bit of a tough spell in the Kenyan markets last year, where we had the central bank being slow to react in the market moves, almost to a point where we felt they didn't want to acknowledge where inflation was going and where it was heading. I think that has changed dramatically. I think we have seen them acknowledge it, move the rates higher. They are more predictable now, as Grace mentioned, and the markets from an investor point of view like predictability in markets. And I think that's what we're seeing now for the central banks, a predictable movements in their rates, probably surprising us a little bit to the upside at the size of the rate cuts now. We were kind of thinking 50 basis points in this rate cut. I think some guys out there were saying 25 basis points in the market. So it surprised a little bit to the upside on the 100 basis points, but they have their reasons for it. They're also obviously looking at the growth side, which is encouraging that they're focusing on that. I think it's also a case of the central bank trying to force the hand of the local banks now to start dropping their lending rates. They've been a little bit slow in dropping the rates, having been burned badly in the massive jump in rates. So I think there's been a slowness in the banks to lower the rates. Hopefully this sends a signal to them now to start lending a little bit cheaper to the local companies.
Grace, let's talk about the shilling right now, because some are saying that further strength is on the cards. They see it strengthening towards 80 to the US dollar. And then we had the central bank yesterday pointing out that there's been, of course, a stable exchange rate for some time now. So what are your forecasts then on this rate cut on the shilling? Do you see there any correlation between the two? Do you see any impact here, especially on flows into Kenya?
Initially, once the cut was announced, we saw some sort of speculative move up, but I think that was not driven by fundamentals. We're going into May. Most of the local listed companies are having their annual general meetings and will be paying out dividends. So we expect that demand to come in. So that will see the Kenya shilling continue to maybe tick up a tad. You would then also see the usual month-end demand coming in, but that would then be balanced by offshore flows, because we still see very strong offshore flows into the equities. So the expectation is for the currency maybe to move between a range of 83.50 and 84.50, thereabouts. Nothing, that's nothing out of the norm. It will be the usual, movements that you'd expect. I don't see the central bank are on hand with enough muscle to intervene and just smooth out those volatilities. So our outlook is just for the shilling to be range bound. 83.50 would be the lower bit, and then 84.50 at the tops.
Grace, thank you for joining us today. Appreciate your time. Grace Makoko, Head of Financial Markets for East Africa at Standard Chartered. Well, keeping in the, Roy, I just want to touch on one thing with you before we move on to the issue of Eurobonds. How is this rate cut going to affect the region in East Africa and the relative attractiveness of East African debt relative to Nigeria and Ghana?
I think you'll see it, the rates in East Africa are following this trend as well, which is good. I mean, Tanzania has been a bit sticky, the inflation's been low, the rates have been a bit sticky to come lower. So I think the message from here will be for lower rates for us in East Africa. Certainly Tanzania, Uganda still looking good, but again, you know, withholding taxes are a bit of a problem for the non-resident investor into Uganda.
So you see rates coming down in that part of the world?
Yeah, I think the trend of downward moving rates to continue and currencies to remain stable.
And we, as I mentioned, that we'd like to move on to Eurobonds because we had the latest Eurobond issue from Rwanda. It's $3.5 billion bid, and you know, seriously oversubscribed book there. I think they issued $400 million ultimately. What did that signal to you? I mean, talk to us about the type of investors that came through for this Eurobond issue, and what did that signal for you?
It signals for us that the asset managers, fund managers internationally are still looking for yield. And the clear signal is that while there's always been a lot of focus on the local currency bond markets, I think the changes to regulation in country, I think the concerns about currencies, maybe they won't get any firmer or they might weaken from here, lends weight to the fact that these guys now look at the Eurobonds. Eurobond issuing at probably around 500 basis points, 450 to 500 basis points over LIBOR. No interest rate, no currency concerns involved in it. The guys are liking it, especially the countries that have got investment grading or countries that have then got a credit rating. I think that's what the funds are heading for now. And I think, you know, for me, it'll continue. I mean, you've seen, you know, this oversubscription here, you know, the oversubscription in the Zambian bonds. I mean, Zambia was fantastic, $15 billion. I mean, you know, and only accepted 500 million or 750 million.
And a small economy like Rwanda attracting so much interest right now, and that final rate coming in at 6.875%. I mean, that's not double digits or anything, you know, that certainly is relatively attractive.
Fantastic rates. I mean, you know, we as I said, it might be 500 basis points over LIBOR, but it's all 550 of LIBOR, but it's still cheap in relative terms in comparison to borrowing in the local markets. And again, as long as the funds are being used for projects, infrastructure build, the future is bright for Africa. You know, and I'll tell you, if we don't continue to see an oversubscription for these Eurobonds through Africa, give up my day job and go live as a mermaid somewhere or as a sea monster.
There we go. Kenya, do you think Kenya, I mean, what type of demand do you see? Because if Zambia, as you say, $15 billion came through in terms of bids, Rwanda, a small economy like Rwanda, do you think you're going to see that size of interest coming through for Kenya?
Definitely. I think that Kenya will issue. The interesting one there, though, Sam, is going to be the Angolan issue. Now, you know, our view back at the shop is to say that, you know, Angola probably doesn't need to do it. They'll do it because it's a tick the box and to please the offshore investor community. I think Angola with an investment rating is going to sell like hotcakes. And
they also Fitch came through with a positive outlook for Angola. They like the fact that reforms are being passed there. They like stability in the economy. I mean, what's your assessment as to changes post the election which took place last year?
Just came back from Luanda, my first trip to Angola, and I tell you, I was surprised at the size of the city and the amount of work that's on the go there. The traffic was horrendous, of course. You can't drive. I mean, it's difficult to drive anyway. But when you look at what's developing in Luanda, I mean, it's growing fantastically well there. And I think you'll continue to see the demand for Angolan assets. Not so much local currency. There'll be a concern around that because the Kwanzaa, there's a bit of uncertainty about funding and about where the currency is. But certainly for a Eurobond issue, it's going to be well oversubscribed. Our view is that, I mean, as soon as they issue, we're definitely going to be buying.
Yeah.
To our investor clients offshore, we think it's a definite buy. So we'll be very interested in that issue.
Given the success of Eurobond issues for countries or for sovereigns, do you think that African banks are going to follow suit?
We've seen one or two. I think it'll be it's more of a difficult sell, because obviously then the credit aspect comes into account. Comes into play a bit more around the sort of credit of the banks. So we've seen a couple of banks issuing paper and issuing sort of, I think, 3 to 5 year bonds. Well subscribed, and make no mistake, there's still a lot of demand for it. But I think we'd prefer the sovereign issue over a commercial paper.
If you're looking at commercial paper, though, I mean, what are you looking for in the size of the bank, the type of the bank, the location of the bank?
I think we're looking at the bank's performance, certainly their profits over the past couple of years, certainly their balance sheet sizes, certainly who the parent companies are from those banks. These are the key things. I mean, a small local regional bank's going to issue, we're not going to get a lot of interest. But if it's a bank that's backed by a multinational in country, we're certainly going to see good interest from there.